we started the week with Reserve Bank of India policy, then all eyes were centered around US Fed, and after the Fed communication, we know that how world has broken down in last 24 hours. Commodities, bonds, emerging market debt, US equities, everything has got shredded, and globally expectations have got reset. So how should one approach the current market environment? Is it a time to buy into the fall, or this is just the beginning of what could be called as a painful period for global asset markets? To understand the current big picture and to pick some pockets of opportunity, let me bring on board Jim Walker, Managing Director and founder of Asianomics, who joins us live from Hong Kong. Jim, good morning. Good to have you back. Thank you for joining us. Jim, do you think markets are slightly irrational in the way they have behaved after the FOMC communication? Because the US Fed has indicated that US economy is regaining momentum, which means global growth is coming back. If growth is coming back, what is this panic all about?
Yeah, well, I think actually the irrationality starts with where asset prices were before the Fed began to say what it's saying, because what we're really seeing now is the reaction to the fact that there's no more increases in money coming from the US Fed over the course of the next few years. That's what asset prices have become hooked on, the idea that there's more and more and more free money coming from central banks. Now, what of course the central bank is basically saying is that maybe you should get used to asset prices being valued on the basis of real economic growth, corporate earnings, fundamentals. And I actually think that's a good thing, and what we're seeing just now is a needed correction to get away from the fantasy land that most of us have been living in for the last 3 years, that there's more money coming without us having to do anything about it.
Jim, hi, morning. So what's the impact of what Fed has chosen to do, the taper talk, and it now preceding it by 3 months? Do you think liquidity is now going to stick with the developed world into economies and asset classes like the US as well as the US dollar? Or do you think funds will now get directed towards emerging markets, and would India be one amongst them?
Well, this is actually one of the questions that seems to, or one of the features that seems to be spotlighted at the moment. The consensus is basically going out there saying that, oh, this withdrawal of money printing is going to be very bad for emerging markets. It's going to be a risk-off period, and we don't get any money anymore. Well, sorry, has anybody actually looked at the charts? Because emerging markets have been underperforming for 3 years. They've been underperforming the developed equity markets for 3 years. In other words, from the very point of starting with QE, emerging markets started to underperform. So why this would then be bad news for emerging markets beats me. So I come back to your point, maybe this is actually good news for emerging markets, and actually I think it is, because the more that we get away from just asset prices being directed by the hope of more money, and start looking at asset prices being directed by how much in the way of corporate earnings there is out there, how much there is in the way of prospects of corporate earnings, what the valuations are, then we'll start to see money flows coming back to emerging markets, because quite honestly that's where the growth is. The US might be doing better than it has been. It's not doing very well. It's at least 2 percentage points below its average growth rate of the last 20, 30 years. Europe is in the dustbin as far as economic growth is concerned, and despite all the hype, Japan's going nowhere either. So the emerging markets really are going to be the story, but I'll be glad when we get rid of all this nonsense and all this hype about money flows, and that really then start concentrating on the fundamentals again.
Great analysis. I mean, with all the bullish talk, US economy or US GDP is likely to grow only at 2.6%, and with all the bearish talk, China is still growing at 7% plus, and India is poised to grow at 6% plus at least for FY14. So Jim, do you think the big story is that one should not panic and use this buy decline to their advantage to only load up, because once the dust settles down, a market like India will emerge as a clear winner? Is that the story? Is that what we should focus on?
Yeah, I basically think that's right. Now, let's be clear, there are a couple of countries, and India is one of them, that have near-term problems and hurdles to overcome. Growth has slowed down. The government still really isn't producing the kinds of facilitation, I would say, to help kickstart that growth again. But for sure, companies are beginning to address some balance sheet problems, and that's going to put them in a much firmer footing within the next 6 months, I would say. China, I've got to say to you, I think is a slightly different category here. I do think there are major problems in China. They might report 7% growth. They're certainly not growing at that level. And on my estimates, by the end of this year, they quite possibly won't be growing at all. But over a 5-year view, that will bounce back, and so will India, and so will lots of other emerging markets. And in Southeast Asia already, the story is still very solid about economic growth. So I think if people are taking their time and just gently beginning to accumulate oversold stocks, oversold currencies, there's no doubt the rupees at that level already, then, yeah, we'll begin to get the money flows coming back in, assets priced at a reasonable level and priced for growth, which I think is certainly going to be the case over the course of the next 5 years.
Jim, the Indian rupee is at an all-time low as stacked up against the US dollar. Do you not think that could be a deterrent when it comes to foreign inflow into the country?
Well, there's two ways to think about it. Of course, what people will see is a falling currency and be concerned that it will fall some more. And then the other view is that this makes India cheap in terms of the buying assets, potentially buying into the equity market, into the bond market. Which one is the stronger at the moment? Well, given the volatility and the way that markets are acting just now, probably people will step back and say, I don't want very much to do with it. The rupee could fall further. Our range for the rupee this year has been between 58 and 60. So we're right at the top of that range. If it went over 60 because people were overselling India and because they'd got too pessimistic, we would be putting out, in fact, we actually have today, a note to our clients saying this is time to start accumulating the rupee, because at over 60, it's definitely oversold.
Are you surprised with the vertical fall in gold, or did you see this one coming? Because I distinctly remember last time when we interacted on this forum, you were a gold bull.
Yeah, the gold price, certainly it's distressing for those of us that are long gold. Admittedly, some of us have been long gold from the low hundreds to the peaks that it's reached over the course of the last 2 years. Yeah, look, again, when people start to adjust their views of whether central banks are going to just keep printing easy money, that they're bound to then adjust their views about the inflation hedge. They don't see much inflation out there just now. But again, I would say to you, I don't think that central banks have completely gone away. I don't think that we've heard the last of quantitative easing. It might not be coming through in America so strongly, but it will still be there probably in Japan, probably in other places. And gold, to my mind, at levels below 1,300 is a raging buy.
Jim, how big a problem could be China, considering lending in China has now chilled because the borrowing costs has spiked up and overnight rates, they've jumped to about 13 to 14%. And if that were to happen, if China really gets into a sticky spot, what would it mean for world consumption and in particular commodities?
Yeah, China is actually a much bigger real story, I would say, than anything that the Fed has produced this week. But when we've looked at the data for China over the last couple of years, we've become increasingly worried about the corporate fundamentals, about the balance sheets at the corporate level, about the policies being followed by the Chinese government. Of course, we've tended to be much more bearish about China than the consensus, and we continue to be much more bearish than the consensus. But the fact is that China has a lot of policy mistakes to put right. It has flooded its system. The greatest inflation probably in human history has taken place in China over the course of the last 4 years. Much of it has gone into capacity that they can't sell now. A lot of it has gone into land prices and property prices, and not so much of it has gone into consumer prices. But the fact is that China has distorted its industrial structure very badly. It needs to shake out excess capacity. It's going to grow very slowly, if not contract, I think, over the course of probably the next 1 to 2 years. that's going to make a major adjustment in terms of people's global perceptions of commodity prices, etc., etc. But China will come out of that period of adjustment stronger, that I have no doubt about, and with better policies, and give it a springboard back towards the 5 to maybe 7% economic growth that it can sustain. And I think India is probably going to be heading in that way as well. And at that point, with India and China will become the flavour of the day again, whereas today, both of them are probably off many people's radar screens.
Right. So, Jim, when do you think the snapping point or the turning point will come for emerging markets? As of now, there is outright panic in emerging market debt and emerging market equities. You know, money managers are selling anything which they own left, right and center, which is remotely correlated to emerging market. When do you think the trade will reverse? What could be that big turning point?
Yeah, these periods tend not to last that long. We're obviously only a few days or a few weeks, probably from 22nd of May, when the Fed first mentioned the prospect of exiting the QE into the correction. But I would say that the summer's a bad time for markets to settle down and for them to then start picking up again. People tend to go away. They try to square off their books if they do go away for holidays. That's going to happen in America. It's going to happen in Europe. So I think the rest of June is not going to be pretty, and probably July is going to see a slide as well. But I would really be thinking to be buying into any weakness that's is sustained into August, and looking for the third quarter, fourth quarter of this year, second half of the third quarter, fourth quarter of this year to be rebound times for emerging markets. I'll be wanting to pick up equity positions and other asset positions over the next 2 months, but with no hurry over the next 4 weeks.
I'm going to ask you a question which is directly connected with Indian investors. Indians are invested in gold as an asset class. So what should an average retail Indian gold owner do? Should they sell the gold they own, or should they buy more gold? Because in India, gold is benchmarked to dollar, and if dollar will strengthen further, gold prices are unlikely to correct.
That's right. I'm not sure that there's any such thing as over-owning gold, to be quite honest, in the world that we live in, where central bankers print paper as if there's no tomorrow. And even though the Fed's not promising to print even more of the paper, it's still printing plenty. I think Indian retail investors are very sensible, having high holdings of gold. And if you look at it in terms of rupees, their gold investments haven't fallen anywhere near as much as for somebody like me that's pricing in dollars. I personally would be advising them to buy more. Not very quickly, you don't need to rush into it, just accumulate it slowly, and keep thinking in terms of gold. It's the store of value when central banks behave badly, and these guys seem to have no other idea but to behave badly.
What's the right equity approach when it comes to India, given the macros that we've just talked about?
Much harder on the equity side to know exactly what to be buying just now. I think it's easier in some other countries. There's not that much in the way of commodity producers in India that we need to worry about as the China story slows down. I think we would probably be looking at the core companies in the consumer and even the utility type sectors, where there's a degree of safety, maybe even a degree of yield. In these uncertain times, those are the kinds of companies that usually outperform because they're defensive. And I think defensive is a sensible thing to be, at least for the next 6 weeks, 8 weeks.
Right, Jim. Appreciate the time and so glad you could join us.